Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, April 11th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, futures are down just a bit. They were up overnight, but they've turned slightly negative here this morning. Right now, I'm showing Dow futures down 20, S&P 500 futures down 3, and NASDAQ futures down about 25 or so. Crude oil prices still just below that $80 level, down fractionally this morning, about 1/3 of 1%, 79.47 per barrel. And the U.S. 10-year Treasury yield this morning relatively flat, sitting at 3.41%. Big news tomorrow will be the March CPI report. So we'll get the latest inflation data. I'm sure those on the bearish side would love to see that number a little bit higher. That is when we've had some pretty big drops. Of course, when we get higher than expected CPI, that tends to put a little bit more pressure on the Fed to raise rates. And when rates have been going up, typically we've seen money come out of many of those growth-oriented stocks, and those are some of the highest market cap stocks. And so that's weighed on the overall market, especially on the NASDAQ. So that's kind of the domino effect of having the inflation report come in higher than expected, but we'll talk about that in just a minute. As far as your agenda today goes, I'm going to start off with the daily market recap, then talking technically, chart of the day, 52-week highs and lows, earnings spotlight, and the 3 you must see. I'm going to go ahead and jump right in and get this thing started. So let's take a look at what happened on Monday. Dow Jones Industrial Average up 0.3%. That was up 100 points. S&P 500 up fractionally, just 0.1%, 4 points. So we tacked on a little bit, still above 4,100. The NASDAQ fell 3 points. Was a lot worse earlier in the day. We had a big gap down, a little morning weakness, as we've seen so often over the last 8 to 10 months. And it was followed by some intraday buying again and got all the way back to about the even point, but we did again finish just a little bit below break even. Mid caps, though, strong day on mid caps, up 1.23%. The small caps up 1.2%. So for the first time in a while, we saw a pretty decent rotation into those smaller and mid cap names. Something to look at, because I did point out, I think it was in our daily market recap to members yesterday, that small caps on a relative basis versus the S&P 500 have hit an area of pretty key support. So the fact that they began to outperform yesterday could be the precursor to a little bit more of an advance on a relative basis. This is, mid caps, small caps, you can see have been lagging for quite a while. Their charts really look almost polar opposite. We've been in a rather lengthy downtrend since that February high on both small and mid caps. You can see that here on the chart. And yet you've got the NASDAQ filling out the right side of a cup, getting all the way back up to those February highs. So just looking at the chart, you can kind of get that feel that money is rotating, and it's not been in favor of mid and small caps. It's actually been the opposite. All right, looking at the sectors, industrials up 0.9%. Energy up 0.8%, real estate up 0.5%, materials just under 0.5%, and discretionary up not too far from 0.5%. So those were your 5 leaders. I think we had a couple of groups that were down slightly yesterday, but for the most part, we were higher. I think technology was down slightly, which helps to explain why the NASDAQ finished just below the flat line yesterday. But overall, not a bad day, especially when you consider where we were in the morning with the big gap down, the initial selling. I call it amateur hour. Mostly that's a lot of times we'll see the opposite taking place. When you're in downtrends in the market, a lot of times you'll get the gap downs, you'll get the follow through, especially when you are at the end of a downtrend. That's when money starts to rotate. So you get those moves down in the morning, and then you get buying throughout the rest of the day as Wall Street uses those moves to the downside to get better prices, and that is the role of the market maker. Their biggest clients are institutional clients, and essentially what they're trying to do is get the best price possible for their institutional clients. So when portfolio managers or hedge fund managers or pension funds, when they want to buy, they don't buy a few hundred shares like you and me, or maybe 1,000 shares. They're buying hundreds of thousands of shares, maybe millions of shares. You don't just go in and put a market order in. If you follow the stock market at all at the opening bell, you know that it's not very liquid at the opening bell. You can have big moves on small numbers of shares trading places. Institutions don't get in and out at the opening bell. Market makers buy their positions over time at the best price possible. So if you look at the market and you're looking for the initial stages of a bottom and a reversal back to the upside, what I look for, and this comes from many years of researching intraday action. But if you look at it, the market will move lower in the morning. Of course, retail traders over periods of time, I hate to say it, but get brainwashed. You keep hearing all the horrible things about the stock market over and over and over and over again for months, sometimes years, but in a cyclical bear market, months. And you start to formulate this opinion in your mind after the market's already dropped that it can't go any higher. It can't rebound. It has to keep going down. And so you see those morning gap downs and you see that morning weakness, and your mind just immediately thinks, here we go again. But you've got to watch and see what the action is doing. These AD lines are on my charts for a reason. Look at them. This is volume basically multiplied times where a stock finishes in its range relative to the high and low of the day. So if it finishes on the high of the day, let's say it's awful in the morning, but it finishes really strongly like the NASDAQ did yesterday, finishing near the high of the day, all of the volume gets added to the AD line. If the opposite's true and you close at the low of the day, all the volume would get subtracted from the AD line. And if you're somewhere in the middle, then it's going to be a percentage of the volume. If you're right dead in the middle, then you're going to take the volume, but you don't go anywhere because you finished right in the middle of your trading range. That means the AD line goes nowhere. That's effectively 0 times your volume, which is 0. So you don't move the needle on the AD line. Follow these AD lines. These are not the most important thing on the chart. This is not my primary indicator. It's my secondary indicator. It's one of several secondary indicators. Ten-year Treasury yield. So this morning, like I said, doesn't show up here on your StockCharts chart, but currently I am showing the 10-year Treasury yield still flat, 3.41%. So right where we finished yesterday. So we're trending lower. We're trending below the 20-day EMA, which is below the 50. And when we trend down in yields, if everything else is the same, if you're just looking at interest rates, when yields go down, valuations of stocks go up. More so in growth stocks. Because what you're doing when you're looking at valuations of companies, you're taking the future earnings and you're discounting back using current rates of interest. So if the 10-year Treasury yield drops like this, and Apple is forecast to grow their earnings by 30% a year over the next 3 to 5 years, this drop alone will send the valuation of Apple higher. If you've done valuations or if you know how to do valuations, you're basically taking those future earnings and you're bringing them back in today's dollars or whatever based on the current level of interest rates. You're discounting those future earnings back. That's how you value companies. So now that doesn't mean that every time rates go down, stocks are going to go up. But that is generally the rule in terms of just looking at the valuation method dealing with future earnings and discount of those earnings based on current interest rates. Now, of course, companies themselves can raise or lower what they believe their earnings are going to be. It has nothing to do with interest rates. If a company lowers its guidance, primary reason it goes down, especially if it's earnings guidance, is because they're lowering their future earnings. So when you discount them back, it's going to be lower than what it was yesterday before they lowered their guidance. Anyway, there's a lot of factors that go into it, that play into it. The overall economy. I mean, obviously, if the GDP is shrinking, then chances are a lot of companies are going to be lowering their forecast, or analysts are going to be cutting estimates. So watching analysts and what they're doing with their estimates can be useful as well. That gets back into the old William O'Neill strategy, the can slim. Anyway, let's keep moving. We got, I wanted to show you in talking technically, the moves off of the June low from last year. So this is when I called a bottom. I know many of you, especially shorts, hey, I get it. If you're bearish, you want to hear people talking bearish. You're looking for people that agree with you. So if you're bearish and I'm not, you're not going to really like my forecast, and you're not going to like my calls. That's, that goes with the territory. If you're bullish and I'm bullish, then you're probably going to think I'm the greatest thing since sliced bread. It's called confirmation bias. So if I'm not confirming your bias, you're not going to agree with much of what I say. But I've been doing this a long time. I've researched a lot over the last 30 to 40 years. I would say in the last 20 years, I doubt that there are too many folks that have researched more than me, just based on the pure number of hours that I put into it. It's a passion of mine. I love this. Love looking at the market. I really like helping people, help them manage their money better, so that at the end of this long journey that we're all on, hopefully you're in a better position financially. If I have a little piece to play in that, that's awesome. But anyway, back in June of last year, I said the bear market was over. Called the bottom right here, told members I was in 100%. 100% invested. And it was literally that day. I don't remember if it was June 16th or June 17th. I think it was June 17th that I wrote to members and said, I am in. I believe the bottom is here. And essentially what I was saying back then is I just didn't think there was much more risk of the market going lower. If I call a bottom, that's what I'm talking about. I'm looking at risk. I'm not just randomly looking at the moon and seeing where it is in position to the sun and where all the stars are aligning and saying, okay, we've hit a bottom. I'm usually seeing money rotating, something Wall Street, maybe it's sentiment. There's usually reasons that I believe that we've gotten to a point where it's not worth the risk to be on the short side. It's not that we can't go lower. It's that it's not worth the risk. Everybody's turning bearish. You don't want to be bearish when everybody's bearish. That's how bottoms form. Anyway, since that time, S&P 500 from here to here is up 13%. I still get a kick in these YouTube video responses when people are saying, oh, you don't want to listen to him. He's called the bottom, multiple times. Well, I did call it twice. I called it here. And then once we went back down late September, I said bottom 2.0. This is your chance to get in a second time. I think it was a pretty good call. I don't know. Maybe if you have your monitor upside down, maybe it isn't, but otherwise looks pretty good. And the NASDAQ's been even better. Since that June low, the NASDAQ is up 18.3. Since its October low, when it finally put in that bottom, that was with a CPI report, by the way, a bad one. And look at that hollow candle. Look at the volume. Really nice move there. And we had a tick up right there in the AD line. That's what that little move was there. Then we had these 3 days on pretty decent volume. You can see that move up. But anyway, 26% off that bottom. You know what? That's a bull market. By definition, you're up 20%, you're in a new bull market. You're down 20%, you're in a bear market. But as I've been saying, to wait until you get up 20%, look at what you left on the table. And if you're using that same strategy to the downside, you probably didn't get out of the market until April of last year, because that's when we went down 20%. So, yeah, I think it's really important to try to call these tops and bottoms and to understand where the risk lies. Here, in my opinion, it was too risky to be short. Beginning of January 2022, I said it was too risky to be long. We're trending up. I mean, there's some are saying, well, we got to get above the 4,300 level on the S&P. And I guess on the NASDAQ, it would be 13.7. To confirm the bull market, I agree. That's what you have to do. But I guess the question I'd ask is, do you have to wait? I mean, if you see other signals that are beating you over the head, do you have to wait to see price action go up 30% before you get in? I don't think so. Anyway, let's keep moving. So I wanted to go over actually, I'm not sure why I have that chart there, the PNC chart, but we're going to go over chart of the day. And what I wanted to show you for the chart of the day is on StockCharts, you can get the consumer price index by typing in $$ CCPI. Now, if you just do $$ CPI, it'll give you the headline CPI number. But if you put that other C in there, it's the core. So it's the core consumer price index. And what it'll show you if you bring it up is just the reading as of each month. So I've set my chart to monthly right there. So that because you only have one reading a month, putting a daily chart out there, not going to do you any good because it only changes once a month. So if you put the monthly chart in there, and then what I do is I make it a long-term chart. So I'm going back 50 years. So we go all the way back into the 70s. So you can see what really hyperinflation looked like back then. And down here at the bottom, I've got a 12-month rate of change. So it's looking at the last 12 months saying, okay, where are we now versus where we were, a year ago, to give us that annual rate of change. And so right now, you can see we've actually rolled over, and we're at probably about a 15-month low on the annual rate of inflation. It's rolling over. It's been rolling over. And that's usually pretty good for stocks. I mean, even back in the 70s, and I don't really compare this inflation to what we had in the 70s. I mean, that was runaway inflation. And some of you might say, well, yeah, but that's what we're going to have. I don't think so. And I think the fact that we've already rolled over is a pretty good sign. When we rolled over initially back in the mid 70s, we actually had a pretty good S&P 500 for a few years, and then took another hit when inflation soared again. And then once inflation peaked and started coming back down, that's what launched the huge secular bull market back in the 1980s, and especially in the late 1990s. But 80s through 90s, market was awesome. And that started with the inflation coming under control. So I don't know how you feel about inflation. You might think we're going to keep going up in inflation. I think if you're going to live by the bear market story, I think that's the one you want to, that's where you really want to hang your hat, because inflation can create problems for the stock market in the long term. There are a lot of folks pointing, well, now we got recession. And by the way, a year ago, probably a year and a half ago, I basically called every one of these crises in advance, saying what was going to happen. We went from the healthcare crisis to the inflation crisis. I said, watch, next it's going to be the Federal Reserve because they're going to start hiking rates. Then we had the Federal Reserve starting to hike rates. And then I said, wait, watch what's going to happen when rates go up. The talk's going to be of an economic recession. And so now what are we seeing? Every time the market goes down, the headlines say, oh, we're fearing a recession. Notice we're not really talking about inflation anymore. Now it's all about the recession. The problem is the market's already gone down. We already went down almost 40% on the NASDAQ. We went down almost 30% on the S&P 500, and we're still way off of those highs. A lot of this is priced in. So watch when the recession talk continues to pick up and the Federal Reserve starts to get away from their inflation rhetoric and starts addressing the economic issues and begins to lower rates. What does that do to those growth stock valuations? If you're waiting for the stock market to take a big hit because of a possible recession, and I'm saying possible, we've still got very low unemployment. People are still scrambling to try to find employees. Businesses scrambling to try to find employees. It's a really tough market for employers to hire. Does that sound like a recession? I mean, not at this point. I mean, could we have a recession in a year or two? Sure. But as the economy starts to forecast that, the Fed is going to be cutting rates like crazy. So then you've got, from a bearish standpoint, you've got to fight that, the lowering of rates and what that's going to do, especially to the growth stocks. Anyway, I thought this was an interesting chart. Wanted to highlight that. For other charts of the day, one thing I will say is that over at Earnings Beats, we do these Monday, Wednesday, and Friday. We send out a chart of the day. It's our Earnings Beats Digest. It's usually 2 paragraphs in a chart. But if you sign up over at earningsbeats.com, scroll down, type in your name, email address, hit that subscribe button. We'll make sure you get set up. Also want to point out this Saturday, April 15th, so we're talking about 4 days, we're going to have our bullseye forecast for the second quarter and beyond throughout the balance of the year. I'm going to go over, it's going to be like a little mini market vision event. Those of you that were with us back in January, you know how I said this year was going to begin. Strong January, followed by a little bit of a rough period, February and March, and then we were going to move higher. Has that changed? I'll let you know on Saturday. Especially, let's get another inflation report under our belt tomorrow. That'll give me a much better look at some of the things that I like to follow. And let's see what the reaction is, how the market reacts. Anyway, Saturday, 10 a.m., you do need to register. We have limited seating. And so if you don't register in time, you may get cut out. You'll get a copy of the recording. Anybody who registers will get a copy of the recording. But if you don't get in time and you're not one of the first so many, our room is limited seating capacity. We use Zoom, so we only have a license for so many seats. But anyway, if you get registered in time, you should have no issue whatsoever. Make sure you sign up. And again, I don't care if you're bearish or bullish or somewhere in between. I'm going to give you some good information to think about. You can disagree with it. That's what a market's all about. But even if you're bearish, you should be looking at the other side, the bullish side. And same thing if you're bullish. Any signals that I have that are bearish, I'm going to be pointing out. Any signals I have that are bullish, I'm going to be pointing out. And then I'm going to tell you which way I think the market goes based on all of that. All right, 52-week highs and lows. What I wanted to do here was basically just show you on StockCharts how you can get to your 52-week highs and lows. If you drop down, look at your scans. If you don't see this on your home page, go over here and click on this gear shift here and make sure scans and alerts are checked off. And if they are, great. Then they should appear right down here, your scans, your alerts. But look under scans under this more button and look at predefined scans. And once you go there, first item, new 52-week highs by exchange. So you can look at the New York Stock Exchange, 52-week highs, NASDAQ. I like to go into the NASDAQ. I tend to trade more NASDAQ stocks just for the greater volatility. But there's your 52-week highs. You scroll down right here, new 52-week lows. Very, very simple. All right. I want to take a look at earnings. So earnings are going to be coming up starting, well, the big ones come out on Friday. JP Morgan, Citigroup, PNC, a number of banks, United Health Group reports on Friday. But we do have a couple coming up this week before that. First one I want to point out is Infosys Technology. AD line's pointing up, so that's giving us a little bit of a bullish feel. But, I mean, we just put in a double bottom. And look at the group, the computer services group that INFY is in. Look at it relative, the peer group, relative to the S&P. It's been falling off a cliff the last 3 months. And INFY took a big hit a year ago, but it's really showing no relative signs of strength in a group that already is weak. Volume trends are weak. I don't know. This one bothers me going into earnings. We'll see what happens. On the flip side, though, we have Progressive Corp, which has been trending higher with a beautiful AD line, supporting the move to the upside. Look at the relative strength of PGR versus its insurance peers. Now, the group itself has been downtrending, but PGR is a leader. If you're going to see a good report in this insurance area, I would think it's going to come from Progressive. We'll see whether or not that's the case. Last one I want to show you here is just JP Morgan. JP Morgan's going down with banks, but JP Morgan is a leader in the banking area. So if you want to know what all this mess we've been going through is going to, what kind of impact that's going to have on the banks, let's first look to JP Morgan because they're one of the best banks. If they take a hit with earnings and they have bad things to say, we want to be careful. All right. Next thing I wanted to point out is your three that you must see. And I'm going to focus on the internet group. First of all, here's internet. You can see internet's been going up. We just broke out above the February high. So this is the time to look at some decent stocks in this area. I like Eventbrite. The AD line moving up. Price has been moving up with it. Nice volume trends. Basically, when we go up, tends to coincide with some good volume. Internet moving up. And there's EB, which has actually moved to about a 9-month relative high a month ago. And it's been consolidating since. I wouldn't be surprised to see a run into earnings, though. Next up, SPT. Now, this one, AD line peaked, starting to come down. It's been going sideways, but it did reverse right at key support level. I'd like to see this one turn today. Again, internet doing well. This stock did okay until about November. And now look at that relative strength versus internet. It's really been taking a dive down to about a 10-month low. That's a little bothersome. And then the last one, I like this one, Yext. Look at this reversing candle right on the 50-day moving average. AD line's been great. Look at the relative strength. Less than a month ago, it was at a 52-week high. It's been a strong stock within this group. It's pulled back as it's consolidated. It doesn't show up here, but I can tell you there was a negative divergence on Yext when it was trying to make this breakout right here. Look at that false breakout. There was a negative divergence. That, I think, is what sent it down, get this 50-day test, and then nice reversal. So it looks pretty good to me. We'll see what happens. All right, that is it for me. I appreciate you tuning in today. Listen, have a great rest of your day. I'll be back on Wednesday over at earningsbeats.com for your next Trading Places Live. And don't forget, Saturday, we've got this April 15th, 10 a.m. webinar, Bullseye Forecast. Make sure you register now. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.